Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant. I am the host of the Smart Property Investment Show. Hope you're well. Here we are again, sitting in the studio. We like doing stuff live in person. I think the world's beyond COVID, the COVID pandemic right now, and thankfully we're able to get people back in the studio, and that's how we like to have a chat with people, because I reckon it's better, particularly when they don't have a lot of talent and they don't talk too well, like Sam Gordon, who's back in the studio with us all the way from the sunny Gold Coast, director of the Australian Property Scout, host. He's a host as well, Scouting Australia podcast, and also the School of Property, which we spoke about last time we got together with Sam. I've dragged him down from the Gold Coast because that's where he is based and located, and I'll be up there later on in the year for ARIC, so we'll have to make sure we hit Moo Moo's again, the great steakhouse, which is Moo Moo's. It's a steakhouse, right?
Yeah,
no, Moo Moo's.
yeah, 100%.
Yeah, it's a good spot. But he's down for the Real Estate Business Awards, REB Awards, which is on this week. So I've got him in the studio, see what's going on. Start of the year, and he always tells me that when we do the top podcasts at the end of the year in December, when we're sort of struggling to find out what we're going to talk about, for some reason his podcast when he comes on the Smart Property Investment Show rank pretty well. And I always say because he comes on early in the year, so that means they've been in the market longer. But he reckons that the content is best. But much like property, the longer you're in the market, often the better it goes.
100%.
That's
mate.
a nice segue, isn't it?
That's very good.
How are you going?
Good, very good, mate.
Yeah?
Thanks for having me back in. It's always a pleasure.
It's good to see you.
Yeah, you too, mate.
Yeah.
You too.
Anything to report? Any updates, feedback?
On the potties?
No, just in general, just
Mate,
seeing what's going on.
Yeah, it's been a great start to the year.
Yeah.
We were just talking off air about the new purchase of the car. That's been a good bit of fun.
Yeah, no one's seen this on social media.
No, this one, definitely kept this one under wraps with the new Ferrari. So, mate, it's been a lifelong goal. So it's been a happy time kind of dropping that.
Ask me about my car troubles.
I know what you've got, mate. Every time we laugh about it, because you got an old what is it?
It's an old Forerunner.
Yeah, that's right.
So what do I need? I was looking at the other. I got to get rust cut out of it, and I don't want to do it myself. So I need a good person to cut the rust.
I think it's time. Come on, Phil.
No. I was actually looking for new door panels the other day on it. So this is my problem.
This is the farm beast, but like you take this thing out to the farm, beat her up.
It's good. Yeah, it's good car for the beach and stuff. But no, I wasn't asking about the car. What else is going on? Tell me something cool.
Mate,
what's happening in sort of Sam world?
Plenty is going on, mate. We launched School of Property in December. I do remember we had a chat about that when it went out. So, man, that's been going great guns. That's been really awesome to kind of put out there and start working with people on that as well. So, as a breakdown, mate, it's 80 plus videos, pretty much, and all these lessons of all the stuff I probably don't talk that openly about. There's a lot I kind of still keep, behind closed doors, a bit more of like APS, Australian Property Scout. IP, I guess you'd put it. So I've pretty much formulated a course and put pretty much everything within that as well that I've learned over the last 15 odd years of investing. And I've learned a fair bit. I've been doing it for a fair while now. So just pretty much breaking everything down within that process.
How long have you been at it now? For those you've been coming on the podcast for probably nearly 10 years.
5 years. So I started it in it was early 2019. So it's I'm in the 6th year of business now.
6 year bit, but as a property investor,
15 years.
15
years.
Years.
So it's 2009 I bought my first one. So the end of this year will mark full 15 years since I started.
God, and you're up. You're a finalist for the REB Awards.
Yeah.
Is it Buyer's Agent of the Year or Buyer's Agency of the Year?
Both.
Oh, you're up for both.
Yeah, both again.
Mate, some big names in there.
There are some big names.
I think then you would know a lot of them, right?
Yeah, yeah. Some good blokes in there. So yeah, man, I'm looking forward to being up for it again. And mate, everyone's saying surely this year, mate, it's the last 4 years in a row. Give me a trophy, Phil. Give me a trophy, mate.
I'm not, mate. There's judges working this stuff out. Maybe you're not doing something right.
Maybe there's something's missing. I'm getting into the finalists, but I'm missing out on the ultimate.
Well, you're doing lots here. So Australian Property Scout, which is a buyer's agent.
Yes,
that's your original business.
Yeah.
And then you thought, how can you help Australians be more informed around property investment? Started the podcast, which I've listened to, Scouting Australia podcast. You do that with
Jimmy.
Yeah. How's he going?
Good, man. Good. Yeah. Good fella. Good.
You running out of stuff to talk about?
Nah, mate. He doesn't stop talking, that bloke.
Yeah. Does he know much about property?
Yeah, he's got about I think he's up to about 15 properties himself now,
Okay.
give or take, somewhere around about that.
Yeah.
So he's doing pretty well for himself as well. But mate, he's got a lot of life lessons of mistakes he made kind of before he started working with us.
Yeah, okay.
And then when he started working with us, we took his portfolio to a crazy level in
You fixed it, did you?
2-3 year window.
What's his job with you guys?
So he's discovery call consultant. So pretty much, he's on the front end when people are wanting to have a chat with us and figure out if it's the right fit. He's the main man that we.
So how does all that work? So you do like podcasts and stuff,
Yeah.
and you're sort of in and around, and a lot of people know who you are now. Do people go, for your buyers agency business? So
Yeah.
I'll talk about School of Property a bit later. Do they just go, hey, you sound like the sort of company I'd like to work with, and they just call you up? How does it work?
The majority of our clients are actually repeat or referred clients.
Okay.
So we probably sit at about, mate, we're probably almost at 50% from that. 40-50% of our business is repeat or referred. We're quite well known for the discounts and what we kind of source for people as well out there in the industry. Pretty decent at picking markets as well, so we do pretty well from that front.
You do say so yourself.
We have a lot of people coming back. Proof's in the pudding. If they're getting revals, they're pulling equity. They're not coming back if they're not making money. So they're doing. If I do say so myself, most of the guys.
That's all right. You can talk yourself up. That's okay.
They do pretty well.
Yeah.
And then the other bulky portion comes from Scouting Australia podcast as well. And then obviously a lot of stuff with yourself and a couple of other platforms.
Well, I know people like you coming on. I was joking before, but
Yeah.
the podcasts we do are typically pretty popular, right?
Yeah. I enjoy them too, mate, because I think you're an investor as well, and it's like we go very deep on a lot of this stuff as well, mate. I always enjoy jumping on with you as well. It's good.
Well, I do
It's
enjoy
always
it.
good
We've been doing it
stuff.
for ages, and I need to use all of my skills and craft and art to try and extract some information out of you, which people can find valuable that they don't have to pay for, and sometimes that's a bit challenging. But so you're busy as ever?
Yeah, it's a very interesting time. The market it's very tight out there for stock. So trying to find good quality deals, mate, we sit at about every single month. We're between 90 to 95% every single month of off markets with what we source out there for our clients as well. So it's very hard to find the right stock at the moment. And on market, you're just paying an absolute premium.
Explain to me what your definition of off market is.
I always laugh about this because everyone, to me, mate, off market is not on the major platforms.
So pre-platform.
A lot of people would call it pre-market. Off market, we do buy things direct through sellers occasionally as well.
Yeah.
Like we would still put a few through a month like that as well. But majority of what we do is like pre-market. From the contacts and relationships we've built with agents out there to get access to them before they go to market, and that's obviously how we can secure and source at discounts.
And this is the buyer's agent business. So you still pretty hands on, like you get stuff. So what's your role largely these days within the buyer's agent business? Is it sort of working out where you should be investing?
Yeah, it's a mix. So I definitely, once a quarter, we get together with kind of like the brains trust within the team. There's a lot of pretty high level intelligent guys in there. Guys that have a lot more, you'd call it like degrees and whatnot than I do.
You don't need a university degree to be good at property, mate.
It's true. It's true. But there's guys that understand a lot within the economic side of things as well that I work very.
Well, that makes up a
closely
good team, right? Everyone's got to have their own skill sets, right?
Yeah, 100%. Yeah. So that's probably like once a quarter. We'll put a lot of time, energy, effort, research, dollars, and everything into that as well to crunch everything and figure out where we're going into next. How long do we still have in markets? What markets are we exiting from? So a lot of time, it's a portion of time goes towards that. I still do a lot of strategies with clients as well, especially as clients get a lot more advanced in their portfolios, going to that different level of building it beyond the average Australian portfolio size on the average Australian income. You need someone that's been through that before to really walk you through that as well. So I still have a very hands-on approach within that as well. So essentially like head of strategy from that. So I have a couple other strategists as well that have decent portfolios in the team too that walk through the initial guys as they're going through their processes and everything. And then I'm still head BA as well. So I still work very closely sourcing deals myself, but then also with the other buyers agents in the business, managing, vetting their deals and seeing, making sure they come through we're buying them for the right price, vetting market value and everything as well, going through comps and whatnot. So essentially valuing those deals to make sure they're still at our standard deal in deal.
Quality
deal
control.
100%, man.
Yeah.
I'll never let go of that. Like it's a tough thing because it's a bottleneck.
Yeah.
We could go to a different level if I let go of it, but then you're also letting go of the quality. And I think that's, you look at the volume of repeat and referred clients that we have compared to even new clients coming in. There's a reason for that. And that's why we had a laugh about it before. But the reason is because the quality control is so strict. The quality of the deals always remains so high.
Well, you have to have that quality control. And I think you can do both. You've got the right systems and process. You still need someone to go, yeah or no. Just if it's, the sort of an opinion which is different to what other people have.
Yeah.
Got to challenge it,
I agree.
It's a business sort of strategy around it called red teaming, which is like, you pretend to be the
consumer.
You pretend to be the adversary.
Yeah.
So this is what I think. You pretend to be the adversary. How would you undermine
Pick
this?
it apart. Yeah.
That's what red teaming is. So it sounds like you do that
100%.
all the time. So you still enjoy the hustle and bustle. So I want to have a chat today because you've got over 50 properties in your portfolio, and we've probably been. That's grown a lot, right? We're only talking about 30 properties like a year or so ago, weren't we?
It was I think 2 years ago. It was in Feb 2 years ago. I think I was sitting at 31 because I think I did 31 by 31.
Yeah, you did. So that's a big jump to 54.
Yeah.
So would you have many clients with similar sized portfolios?
Not at that size, no. I'm very aggressive with my approach because it's over 10 properties a year I've acquired over the last 2 years, each year, right? Over 10 properties a year. But the difference of what I source compared to what a lot of clients will buy as well is a lot of the time the real hairy stuff that comes through. So like big renovator deals or something might be structurally, a bit messed up or whatever. I've got the team that I know I can fix pretty much almost anything that comes through if the dollars make sense.
Yeah.
It's a bit too risky to put onto most clients. I've got some clients that have a big enough set of cojones that they'll take that sort of stuff on.
Yeah.
But most people, it's too risky from a business perspective to put it onto them. And there's just not that many guys that are willing to take on those hairier sort of things. And with how much deals we get access to, how many deals we get access to, we pretty much one a month will come through that'll be like that. That'll be super hairy. And you just got to work out the numbers, exactly. Or even if you're giving yourself a bit of buffer, but that they make sense. If they make sense, I'll pull the trigger on it and do those deals.
And that's risk return. It's only when you've been around it a lot and you've got quite a large portfolio and you've got a lot of experience, you can actually take on those things. And one of the biggest challenge for property investors is they tune on the podcast like this and get a couple of guys like us with pretty big portfolios and we talk quite flippantly about it, right? And they go, well, I want to play that game.
Yeah.
Right. Well, yeah, you can play that game, but you got to do a lot of hard work, a lot of pre-season work to do
100%.
before you start even thinking about that. But people get absorbed and obsessed by it and they'll be like going, I don't want that deal. I want one of those big deals. You just not. You can't. You can't do it yet.
100%. On Scouting Australia podcast, we talk a lot about the levels of investors and pretty much kind of like defining that and how it works as well. And when you're starting out, you got to cut your teeth on stuff that's easy for you to comprehend. And it's not because you couldn't do bigger than that or whatever, but it's like your level of experience and your level of like mental clarity and like ability to kind of take that on, and almost like a mental strengthness from that side. It's not big enough yet to take on all the shit that's going to come off the back of that because it's not straightforward. Things pop up all the time. They're hairier. Sometimes they come out better than you think, substantially better, but then sometimes they come out worse. And, taking that thing on, if that was your first deal or your second deal or something like that, like it'd blow your head up. It'd do your head in.
Yeah.
It's you got to chop through the different levels of investor, level up both the experience and then also the knowledge around it all before you take that stuff on.
You need a lot of scar tissue
100%.
and you need a lot of experience to be able to navigate that. Like I've done deals before where people just go, but you see the deal. You go, I can actually say, and you go, I know how this is going to play out.
I know
and right up front that it's going to be messy, and you've got to make sure the people you have around you are comfortable operating in that environment. Because if they're not, they'll just go crazy, right?
Definitely.
Just because, I don't find property stressful because when you do something enough, it just becomes normalised, right? You go, that's just the way it is. Whereas other people, they'd be not sleeping at night and all that sort of stuff, which is bad.
Even like a simple thing of like, you look at a lot of people when they move past the bankers and they move to brokers, and then they start complaining about the broker system. And it's like, but you've got to remember the broker's got to play a different game to the banks. They've got to go through compliance. They've got to work through the different structures and strategies. It's a completely different game. But because it wasn't as easy as the banking side, which is just, no worries, this is what you make, this is what you can borrow, here's a loan approved. It's so simple and quick because it's right at the start. It's literally, that's a leveling up as well going through that. But when you first do it, it's a pain in the ass. I can remember when I first started, I hated it, and it was so annoying and painful. And then these days, I don't even think about it. You just get everything. They ask for it. Yep, no worries. Here's this. It's just part of the process.
But you just know that's the way it is, right?
Yeah.
So it becomes normalised.
Exactly,
but you can get that through experience. So we'll talk about your portfolio later on, Sam, because I'm quite curious what you're buying. not going to tell me where you're buying, but I'm curious about what are you buying, and I sort of want to learn a little bit more about the School of Property. While I got you, mate, I'd like a sense from you, and I spent a bit of time in and around Canberra talking to politicians and that sort of stuff, right? And I think, and I'm telegraphing that the upcoming federal election, which will be next year at some point, will happen this year, a lot of it's going to be fought around taxation regime.
Yeah.
We see already, there's a by-election coming up, and they reckon it's going to be a real first test on the government around changes to stage 3 tax cuts and stuff, which would have impacted you, no doubt, because you've got heaps of money. Unbroken promises and all this sort of stuff.
Yeah.
But the discussion now, it's all over the papers today even, is around negative gearing, this negative gearing debate, right? And some new research has come out pretty much going, a lot of Australians, I can't remember, let's call it 30% or something, get rid of it. It's not fair. You got the other side saying, don't get rid of it. And then there's a whole bunch of people in the middle that just go, I don't know.
Yeah.
I don't know. The coalition's completely ruled it out, gone, not touching it. The Labor government is batting back at pretty much going, nah, we're not going to touch it. But the Greens are adamant at the moment, trying horse trade around this help to buy scheme and trying to get changes to the tax regime for property investors.
Yeah.
Pretty much saying that Australian property investors are essentially the pickpockets of the Australian tax system, right?
Yeah, right.
Is that sort of changing how any of your investors are thinking of it? Has anyone said to you yet, I'm not going to invest because I don't know what's going to happen with capital gains tax and or negative gearing?
No. So I think
is it just noise at the moment?
Yeah, and if anyone ever asks it, that's what I always say, because it's like nothing's ever guaranteed. Things come in, things go out. If you sit on the sidelines, like I had clients sit on the sidelines, or people who came to us and were going to work with us and then sat on the sidelines because interest rates started to run. Yeah. If you bought property at the start of the interest rate run, which was about 2 years ago now, there's heaps of properties that we bought for clients that have done between 70 to 80%. Some of them have doubled in 2 years.
Pretty good.
Buying in the correct market and buying at the right price and getting that proper uplift. Imagine if you sat on the sidelines and you passed on a deal because interest rates started to run. And I can understand the wariness of it, but it was just like people being like, well, interest rates are supposed to be this low because they've only invested for a year or two and that's what they're used to, not looking at the long-term averages, which is kind of around about where we are right now or a little bit less. When I look at all this stuff, 100% I look at it as noise. Because if they scrap negative gearing, yes, there's going to be some tax concessions that we lose, but then what are rents going to do? Rents will go crazy. People will opt out. It's going to cause its own issue. You look at the state tax with the land tax and the grouping and everything they were trying to do in Queensland.
Yeah.
If people go back to whatever episode it was that you and I did on that, I think I was about the only person that I heard that was out there calling it's not going to stick. And this was after they had brought it in. And I go, they're going to backflip on it because someone will
it's
get
because
murdered,
our podcast. It's because our podcast ended up there in Parliament House.
That's
up
it.
there.
It must have been.
And it pretty much went, look.
But with these huge changes, like, and this was my honest opinion at the time, it's like it's almost like it's too big to try and shake now. Like maybe at some point it'll come in. Yeah. But I remember calling it, just going like, it can't happen. The vacancy rates are already stupidly low. And what happened? As soon as they brought it in, everyone stopped buying. Like Queensland came off on a dip for that next 6 to 12 months because of what they did and what they were trying to do there. So it's one of those things like, you take it into account when you're making decisions, but you don't let it change your decisions. Your overall strategy, obviously this is something we're about to talk about now as well, but your overall strategy should never really change unless something is going to significantly impact you. But you even look at, and you talk about this as well with the tax cuts and everything, ultimately everyone still won from those tax cuts. Yes, the bracket didn't move from 180 to 200, but it still moved to 190. So you're still $4,500 in front from where you're going to be. You're still in front. Yeah. So I think it's one of these things like mate, I just invest. I invest in what I know is gonna do well, gonna make me money, gonna give a return to both myself and my clients. I stick to that, focus on that.
Irrespective of the tax regime. 100%. So if your investments stack up before you put tax into consideration, you're okay.
100%.
Right, and this is the issue with property investment and maybe some of the inverted commas strategies out there. They'll say your strategy should be negative gearing. Let's get you off the plan. Let's buy today. Yeah. It'll be built in 3 years' time, and you can negatively gear it and all this sort of stuff. So
you'd be worried if you bought that. You'd be concerned if that was a strategy when you bought that thing as well. Definitely. But
yeah. So all right, well that's common sense prevailing there.
100%.
And I think it'll be very brave. The problem is we're talking about it, right? So we're giving this oxygen.
Yes.
Is what sort of annoys me about it all because but get used to it. This is going to be the way it is running up to the election. There's a lot of discussions around taxations. But did you sit there sometimes and go, you watch the TV and you might watch Insiders or whatever. I watch Insiders. It's a sort of political show on a Sunday. And they go, it's $2,000 tax saving. Do you sit there and just go, it doesn't even move the needle? Like the quantum of it all is largely irrelevant. Even if you're looking at negative gearing, I think your portfolio is pretty positively geared. So you pay tax this is what a lot of people don't talk about. What about all the property investors who contribute to the tax receipts because they have positively geared property?
100%.
And there's a lot of people, like, I don't know if it's most, but I don't know. I should really find this out. There's a whole bunch of people who invest in property who make positive gains out of it.
Definitely.
And pay tax on it.
Yeah. Yeah, 100%.
So they're contributing. No, this hasn't even come into the debate. No one's said, what about all the people who raise taxes?
I think too many people are vested in it as well. So, like, if you have a look at the, you have a look. I think it was Labor it was late 2019. I think it was.
Yeah.
When we're coming up to that federal election, they looked like they were going to win it 100%, hands down. Everyone was saying it. And then it was coming out around the negative gearing and that they were going to scrap it. And then all of a sudden there was that, do you remember there was that like paradigm shift around that at the time?
Yeah.
And everyone thought they were a sure foot to win it. And then what was the big thing that changed it was the coalition then go, no, we're not going to change it. And that was their strong arm. And that was the battle. And almost there was a lot of people out there that I think voted with that in mind as well.
Yeah, it was that, and by memory also, they were trying to mess around with self-managed super fund taxations on retirees and stuff, and it's like, don't mess with people's rice bowl.
We're too vested in property in Australia. Yeah. We've got too much love for it, too much passion for it. And too many people are invested in it. That's their wealth strategy. So you start playing around with it, you're going to start getting some knives.
And this is why you've got to put things into perspective, right? Like we're talking about this help to buy scheme, which I think is like 10,000 properties a year, right?
Okay.
Which is it's a fraction of properties that are sold.
Yeah.
So again, don't get too caught up in it all. Make the right decisions. But no doubt if you consume content on School of Property, you'd probably know all these things, wouldn't you?
Yeah, mate. I don't think you're getting too worried about the headlines.
No? What is the School of Property? Remind me and our listeners.
So School of Property is essentially, it's the education hub that I wish I had when I started out. So I kind of always like...
That's a good elevator pitch.
Thanks, mate.
This is the education hub I wish I had when I started.
It was the first time I ever said that. Like, I just came up with that just then.
It's really good.
Thanks,
it's really simple. I get that.
But when I started, actually, we've had a laugh about this because the first property magazine I ever picked up was Smart Property Investment. All the way back. I was 20 or 21 sitting in the dentist and I picked it up. And then I was reading this thing, just completely engrossed in this thing for 10 minutes before the dentist came out. And I said, mate, can I have this? He's like, yeah, whatever, no worries. Because it was sitting there on the table. And then after I left, I remember I was sitting in the car and just reading this. I read this thing back to front. And then I drove down to the newsagent and I bought, there's the other two that were out at the time as well. And
API and Yip.
Yep, that's the one.
Yeah.
That's
all gone now. None
of
those things exist.
All gone. I won the last Investor of the Year ever that was with Yip before they wrapped up. Yeah.
How did they work that out?
Little claim to fame. I don't know, mate. They've obviously got a better judging system than the REP.
There was. Not as desperate.
But mate, it was just like I consumed so much content, and podcasts weren't around back then. So for me, it was the magazines, and I subscribed to them and I read them back to front every single month. And I just kind of started formulating this strategy, and I applied things and I learnt things and I made mistakes and I made wins, and then I kept refining, kept building it, ultimately, which led into Australian Property Scout. And then it's been playing on my mind the last couple of years that like, the podcast is good, but I'm always, like, there's always a little bit that I will hold back. It's the same as when I jump on here, because it's kind of like the stuff that I reserve for the APS guys, that we're working with. And so I just thought, well, people always ask me for it. And there's people that are wanting to do it themselves, or there's people who are, there's a lot of people who are working with this. It's just like, I just love to know it and kind of go through it and everything as well. And so I just decided I'm going to make this thing. I'm going to put it out there. If people want it, they can buy it. If they don't want it, they don't have to. But essentially everything that I wanted to, learn, and the things that I learned that were really, really important in my journey, and pretty much like my philosophy on investing, which is pretty much ingrained in this course. And yeah, like I said, I think there's about 80 odd videos, lessons ranging from, there's a little foundational section that's like 20 to 25. They're all about 5 to 10 minutes, but then everything else is about 20 to 40 minutes long. Just a breakdown of everything.
Who videoed it all?
In the podcast studio, in our podcast studio. I know, mate. I was cooked at the end of it. There was that much stuff that I put into this.
Was
thing.
it all scripted, like written down, or you just sort of?
I just had a heading, and then I just wrote it out as I went.
Okay.
Just like a title of each ep sort of thing, and then I wrote it out as I went. But man, there's everything in there. There's a financing module, which I know we're having a bit of a chat about on that as well. But there's an accounting module with my accountant, personal accountant. There's a Trident formula breaking down how all that works.
That's your formula, is it? Trident.
The Trident formula.
Trident,
yeah,
that's right. So it's got to do with 3 things, has it?
That's it. The 3 prongs of the Trident. That's it.
Yeah. What's the middle prong?
The middle prong?
Yeah.
So you got bread and butter deals, cash flow deals, and then DRDs, which are debt reduction deals. And it pretty much just breaks down how they all work in a portfolio, and then how do you build them into your portfolio, and where do you build them in?
It's sort of in that order, I imagine, right?
Yeah,
bread and butter. What was it? Bread and butter.
Yeah, which is your growth properties.
Yeah. And then cash flow. So you've got to hold your portfolio, and then it's about sort of retiring your debt.
Yeah, debt reduction deals on the back end.
And like, you call it the Trident formula.
Yeah.
Trident formula. Trademark pending. Or
That's it, mate. It is.
Yeah. But what I like about you, not a lot I like about you, Sam, but what I do like about you and what you do is that, like, property is simple. Like, it's if you don't understand what someone's telling you, like, just go, man, it's just like not the way. Like, it's simple.
Yeah.
Buy good properties.
Yep.
Hold on to them, then try and get rid of your debt. That's how you create wealth in property.
Yeah,
it's not hard.
There's a few more things you want to be really successful with it, but
that's what you get from the School of Property.
Exactly, mate.
Yeah.
Exactly. But there's heaps in there, man. Like, that's just scratching the surface. There's real deals where I literally run through deals I've done for clients, for myself. Man, so my two favorite lessons in this thing. The first one is.
Oh, you're actually going to give something away?
I'll just say what the two lessons are. The two lessons.
Okay, all right, good.
I've got 2 favorites. The SMSF is huge. Obviously, I had to get a lot of legal advice, financial advice around how far in depth I can go with it. But a lot of people underutilize their SMSF, or they don't touch it because they think, oh, buy one property and let it sit there for 30 years. I don't know if it's the right thing to do. Maybe I will, maybe I won't. They don't really do it. And when I break that down, for a lot of people who listen to it or have watched it, or sometimes I break it down with APS clients in a strategy session, and they're just like, whoa, like that's. Especially people who bought school property, they're like, just that lesson was worth the.
So trading in your SMSF, just being active,
learning how to build it properly, not just buying one deal and sitting on it for 30 years. Understanding the way that you can actually build it, how to structure it, and obviously everything to do with this. You got to speak to your financial advisor about it because it's not for everyone.
Yeah.
But the SMSF, in my opinion, is probably the most underutilized vehicle out there in Australian properie.
I come into work early this morning and. I started off looking at my share portfolio, and I have, a share portfolio inside of my super fund. I just went, I'm just wasting this money. Like, it's what I thought, and that's not financial advice.
No comment. At all. No comment.
But I just looked at it, just going, like, there's a couple of properties there I could just buy.
Yeah.
And I'm sort of going, oh, that's up by 1%.
Yeah.
It's not red anymore. It's green. It's So I think a lot of people do. If you're busy and you've got so many other things going on, you often neglect your superannuation and or your self-managed super fund.
Yeah, 100%.
I certainly fall into that bucket. So how does it work with School of Property? Like, does it cost money and stuff?
Yeah. So it's essentially like Scouting Australia podcast is essentially our free content vehicle of what we give away.
And you find that just wherever you're listening to this on
or your big
Apple or whatever.
Your big normal platforms, you'll find School of Property, and that's got heaps. Like we kind of model it, not the same, but they're kind of similar. We do a lot of like content pieces where we'll explain different investment strategies and all the rest of it. But then we'll do investor stories, client journeys, even some of the staff with what they've done as well, and kind of go deep. A lot of what you do on this sort of stuff as well, and what we've always done over the years.
Yeah, cool.
And it's just pretty much it's our investing methodologies, right? Broken down essentially in that podcast. Scouting, School of Property is essentially the jacked up, right? The steroidal version of the Scouting Australia podcast.
Yeah.
Everything that kind of gets hidden behind a curtain or doesn't 100% get explained. Or it's just like pretty much this is broken down. So from start to finish, it's like leveling you up as an investor the whole way you go through it. And the exact way that I would do, if I was to start again and I had no knowledge, if I watched this thing from start to finish, you would level yourself up massively as an investor.
So you start step by step, or you might enter it part way through. Like if I was going to, I guess you subscribe, do you?
It's like an online learning platform sort of thing.
Cool.
Like
so,
you log in online.
So someone like me that's been around a bit,
Yeah.
I might enter 3/4 of the way through it and, the basics are still there, but I can find the stuff that's relevant to me.
Yeah, you'd probably skip the fundamentals, or you'd probably read through the fundamentals. 25 videos there. There's probably something that you maybe haven't thought about. There might be something there that's a bit different outside the box. So there might be a couple of videos in there worth watching. And then Trident formula, again, it's one of those things, you understand it from that side of things. But when you start getting into the strategy piece, I build portfolios very differently to 99% of people out there. So there's different things within that again, 99% of people either don't think about, haven't thought about, they're just investing in the wrong way, in my opinion. And then you start going to real deal section, different lending types, different structures and all that sort of stuff. There's a lot within it. And the advanced lending module, the advanced investor module, which is just where it's got a lot of those extra videos that just go to that next level. There's a lot of things in there that probably just like challenges the thinking of what a lot of people grow up learning about, thinking about other people's ideologies about investing as well.
So how do people find it? Just Google School of Property?
Yeah, if you go to, so the easiest way is probably just going to www.australianpropertyscout.com.au. We've got a little education tab on there, and that's a School of Property. Yeah, pretty
you
much.
got like a coupon code or anything? Like people listen to the show get something cheaper?
There you go. Throw SBI in. Throw SBI in capitals.
Do you actually have it, do you?
Yeah, I had it from last time.
Oh, really? I didn't know that. Okay, I'm certainly joking. There you go.
We cancelled it out. Like it was up until December 31.
Okay.
So I kind of had a coupon code for SBI and for APS as well, and then pretty much finished it. But there you go. I didn't even think about it, mate, but that makes sense. There we go.
All right.
Little bonus for listeners. They want to jump on.
I'd like to have a look. Maybe I'll get it for free.
I'll give you an insider peek.
I'll give you a review.
All right, mate.
Now, I want to talk about your portfolio. Let's go to a break. We're probably going to strap in for a bit of a longer podcast to run. Welcome back, Phil Tarrant from Smart Property Investment with Sam Gordon from, where do you want to be from? Property Scout's probably the best thing.
Australian Property Scout.
Australian Property Scout. Yeah.
That's still my baby.
He's got a podcast as well. You've probably heard about it. It's in School of Property. But first and foremost, this is a question. First and foremost, are you a property investor or a property professional?
Property investor.
First.
100%. 100%. I love property, mate. I love buying property. I love renovating. Love developing. I love forcing value, finding strategies. I live and breathe property investing. I still get excited and on deals, deals that I know there's something juicy. I still love it.
You still love it?
100%.
Okay.
Yeah.
And is that where you'll create true wealth, do you think? Like, you've got a good business and stuff and you're helping, but property is where you'll make big dough, right?
Mate, I built a 20 property portfolio making less than $100,000 a year as a PAYG income.
That doesn't happen, though. Can you do that today?
Yes. Mate, honestly, School of Property will explain it properly. No, I didn't even mean to lead into that for a plug. But you just got to know how to play the game. There's so many different ways of doing this thing. You got to buy the right properties in the right location at the right price. You got to put the cash flow deals in at the right point. You got to structure things correctly. You got to finance things correctly. You can't do it all yourself. You need a correct team around you that can take you to that next level. If you're trying to do it by yourself, no, you can't. But if you have the right team and you understand all this, 100% you can still do it, man.
That's not passive, though. You're working hard to do that, right? Like, you're living and breathing property. Like, if you don't want to do that, you're not going to do that.
But most people don't need a 20 property portfolio when they're 28, 29 either.
Why not? Work for you.
It worked for me. That's the thing. Like, not everyone has to go that hard and push that hard, but it is still possible. 100% it's still possible.
Have you ever redlined it so far it nearly fell apart and they blew all your dough? Was it always been quite robust?
Yeah. Now, when I was in my mid-20s, because interest rates were still pretty high. I think they were around in the sixes, around about sixes.
It's about where we are now.
Yeah. And it was pretty. Yields were a lot lower as well. There was a bit more yield compression around. And yeah, man, there was a few bits because I kind of went down a little bit of like a blue chip route. I was going for things that were a bit bigger, a bit more expensive. Yields weren't as good. And then I started bringing in some different properties, lower price point, nice equity gains on them with better cash flows. That started to make it good.
Yeah.
The issue was I was redlining my equity. I was stripping equity because I was, at that time, I would be making like $60,000 a year, like nothing. So I couldn't save anything for it. And this is where I started to learn more about positive cash flow and when to build them in, different strategies around that. And that's when I started to play that game. And that's when the portfolio really leveled up. And that's where it all comes down to a balance,
Yeah. And look, what you've been to create is pretty cool. So how big's the portfolio now?
54 properties.
Okay. And do you sort of tell people what it's worth, like what the value of that is, or is that you keep that on a download?
I can't. That's all right. I kind of keep a little bit.
That's okay.
Personal.
Right. So, what would be the most expensive property in that portfolio? Give me a sense of the dollar value of it.
Probably the biggest one I've got is a dual lockie that I did down in It was 1,100 squares, and I bought the vacant land. Got this thing off market, negotiated. We actually ran through this.
Just down Southern Highlands.
Yeah,
right?
it was only a couple of years ago. Yeah. And I built a specky on the left, and then I chopped this block. It was very awkward, and no one really saw how you could do it. And I just kind of figured out how to make it work. And I essentially split that one and built on the little top section there as well. That would be worth sort of combined 1.6 mil.
Okay.
Yeah.
So most of your properties are under 1.5 mil, or probably under $1 million.
Yeah, definitely. Yeah. So all my stuff in Sydney is worth over $1 mil.
It would be.
Probably range from 1.2 to 1.6, 1.7, something like that.
That's just standard prices, right?
Yeah.
Have you got much here in Sydney?
A bit. I've got about. Nah, not too. I think it's a handful left in Sydney. I sold a couple off when COVID peaked out. There was a lot that I'd made a really substantial gain on. One of which what I sold to buy my cars and whatnot as well. So, man, I kind of play that game. It was good because I was able to buy them in cash and do it like that. So, but yeah, I still hold a few of them. Predominantly the cash flow ones that are doing really well, and they're very, very net positive.
Yeah, okay.
And then newer builds
because the debt position on them is probably quite low,
Yeah.
right? So it's good. Yeah, and you're going to get that. But what the picture I'm trying to paint is that they're not multi-million-dollar properties. They're the sort of properties you're probably largely buying for your clients.
Yeah.
At different levels.
Oh, definitely.
Yeah.
So, like the bulk of what I would have bought for myself would be between $300,000 to $500,000.
Okay.
A lot of those have now doubled and are worth a lot more. I got a lot of cash flow deals that I probably bought for around.
What do you mean by a cash flow deal? What's a cash flow deal?
It varies. So probably the easiest things are things like unit blocks.
Yeah.
So I got a couple.
I
of
love
unit
unit blocks.
So do I.
I wish I had more of them.
Yeah.
I was actually just doing some sums the other day, and I got a block in Launton, a Petrie way near the university.
North Brisbane, yeah.
It's cool.
Yeah,
So
that would be doing all right.
Yeah, it's great. I think I've just bought the whole lot for under $1 million, right? There's five properties on it.
Yeah.
It's like one big thing. I could develop it sometime, go 20 stories, right?
Yeah.
Right near the train station.
Good little land bank as well.
It's a good little land bank, but just eking up the rents on it all. I was able to lift about $80 or $90 on one of them. Which will now be the new benchmark. Like, they're great. I just said, I wish I had more of these.
You know what's the best as well?
You can't find them. Like, they're just
very rare
don't
now.
exist.
Yeah, they're very rare. We probably do about 1 or 2 a month, max. That's probably and that's the whole team like searching at the same time as they're doing it.
But this off-market stuff, like strated or non-strated,
it depends.
A bit of both.
Yeah. So we always buy the whole block. We won't typically buy an individual by itself. But yeah, we're always buying the whole block. Typically ranging anywhere from like 3 to sort of 6 to 8 sort of thing. But they're super, super rare from that front.
They just, mate, they're gone. Like, you just can't get them.
Yeah.
And investors that get them now, like, you'd be hard pressed to sell.
Yeah.
Because the yields on it is good.
Well, when I bought mine, I bought the bulk of mine sort of 3 to 4 years ago, and I got 3 in the portfolio. I would have bought all of them between that 3 to 4 year ago mark. They already yielded at the time about 8 to 10% yields across the bat. I did some light cosmetic renos, didn't do anything crazy to them. Did light cosmetic renos to 2 of them, and one of them haven't touched. The one I haven't touched would sit at 12 to 13% yield now. Probably even actually a little bit more.
Whereabouts?
That one's in Queensland.
Okay. In Brisbane or out of Brisbane?
Out of Brisbane.
Okay.
And then the other 2 are they're actually in Adelaide.
Okay.
And they're almost at 20% yields now. They're massive, and I've owned them for because I forced some value
on the purchase price.
Purchase price, yeah.
Okay.
Yeah. I value yields on purchase price. I don't go on current value because if a market doubles, it did what I bought it to do.
Yeah.
But then also if the rents go through massive growth, like that's what I paid for it, and so I'll do like what I paid for it plus reno costs and stuff. That's what that deal cost me, And then I might pull all my equity out that I put into it, but I'll normally leave it at that. I'll pull my equity out, move that onto a different deal, migrate that elsewhere. Yeah. But then I'll leave it sitting at that level. So it leaves them ridiculously positive.
And people sometimes get a bit obsessed with yields, but yields can be whatever they want. Like I measure yields 4 ways, right?
Yeah,
like on purchase price, on total establishment cost.
Yeah.
So including stamp duty and all the other stuff around it. On the current valuation, and then also on the debt.
Debt level, yeah.
Yeah. So, but you look at it and just go, okay. And like you just go, but you can benchmark across your portfolio, which is cool. But you still look at the bottom and go, is it in the red or is it black?
Yeah.
Am I paying tax on this?
Yeah.
Or am I getting a negative gearing benefit of it? And I would much rather have, and all portfolios or properties and portfolios over time should move into a more neutral and or a positive cash flow position
100%.
if you don't keep loading it up on the debt. Like if you stop absorbing more debt, it'll just naturally turn into that, right?
Yeah,
And that's
for
the
sure.
idea. You need to. You're pointing around to try it, and you want to start retiring debt, right?
Yeah.
That's one way for doing it. So you count. So if you've got 5 properties in a block or 6 in a block, that's 6 properties.
I do count as that.
6 doors.
Yeah, because they're normally
six
like all
individual.
worth 300 to 400 grand a pop, especially now. So yeah, man, like I definitely still count them as single door.
So would you buy more, like as part of your portfolio growth? Would you buy more unit blocks if you can get them?
I think these days, no. Yields aren't really strong enough for me to warrant doing them. I prefer what I do these days is I'll typically buy something like a granny site. And if the house is a bit messed up and I can go in there, got the reno team, smash out a good reno on it, maybe build a granny out the back and get a good, a lot of the time you can get 8% plus yields. If the house is proper messed up and you've got to spend a fair bit of money and you're getting it for a really good discount, you might clear 9% plus sort of yields with a brand new dwelling at the back that's got depreciation on it as well. So you're not paying full freight tax even on your profit there. So they're the sort of fields that I'll play in these days. And we do a little bit of commercial as well.
So do you count a granny flat as another property?
No.
Because it's another rent?
No.
You just go, okay, it's one of those things.
So that's it,
I have
house
no
and
granny flats.
Really?
I've never done it.
Really?
No. No, I've just gone, I can't be bothered.
Yeah.
I just got.
I was like that at the start.
Yeah.
And then the equity started growing so much, I started playing in the game of, well, I'll pull the equity out and I'll build it in cash so I don't have to worry about it. And I build 3 or 4 at a time. So every 6 months, I'll normally see what I got in the portfolio, what can I pull the trigger on a granny, and I'll cluster, all right, I'm going to build these ones all at the same time, and I might build 3, and I'll build them all at cash. And then when they're finished, I'll refinance that back out and move it on to the next ones.
And do you use the same company do all your granny flats?
In the same area, for sure.
Yeah. How do you find them? Just people you know?
Oh, it's just building connections. It's just, at first we'll kind of we quote up with a lot of builders when we first enter an area, and then we might whittle it down to say 10, and then we'll go through all the grannies as well, like recently completed ones, see what they're doing, see what sort of volume they can take on, see how reliable, how likable they are as well, because obviously our clients have got to work with them a lot as well. And then, we pretty much just I'll normally pick 1 or 2, trial some builds.
Yeah, do it everywhere. Same granny flat as well, but based on the site, you just go, that'll do same colours, same fitting, same fixtures, same.
I've got 4
colour.
designs.
Okay.
4 designs I work with, and it ranges across the board. There's a 3-bedder, there's 2 2-bedders. There's 3 2-bedders. There's just different sizes and orientations.
Do you just make them like normal? You don't do all the fancy sort of architectural sort of.
No, I utilize space really efficiently.
Yeah.
And especially like the reason we got 4 is because I got like a skinny and then I got a super skinny, which I can fit in, but the super skinny is still mad. It's still like a really, really livable design. So I pretty much, our standard 2-bedder is what we would roll out 80% of the time. And that's just tried and tested, mate.
You pretty much
hundreds
put
of them.
granny flats on most blocks these days if you've got the right sort of.
It's got to be the right block. Like this is a big thing. I don't like compromising either. Like a lot of people just dump them straight out the back of another house, walk through access, and there's just like they're right next to each other. It's just you're just going to create issues.
Yeah.
Whereas if you set them up properly, I love battle axe style. So drive through, fence it off, nice little deck, tiny little yard sort of thing. So very low maintenance, but they're very separated. When they're very separated like that, they're literally a great property. And almost all the ones that I did, even let's say 2-3 years ago in Brizzy, that I might have done them at 8 to 9% yields because of the rental growth I've had. Now they're all sitting at like 14-15% yields. Like they're pretty good. They're crazy.
So this is the cash flow stuff that you need. So the portfolio doesn't cost you any money to hold now. You're paying tax on it.
It's definitely in the green.
Yeah. So okay, so Sam's one of those people who is contributing to the tax coffers of Australia. He's not one of those evil property investors negative gearing. But so what have you been doing in the last 10 properties? Like just really quickly, what are they? Where are they?
It's a bit of a mix. The last 10 are all in either Queensland or WA. Okay. We've got a lot of new locations.
Everyone's in WA at the moment.
It's a mix, yeah.
Yeah, you'll see the Fast 50 report for Smart Property Investment will be out by the time you tune into this.
Actually, did it come out yesterday?
Could have.
I think I saw it hit the inbox, when I was on my way. I was getting ready to come down here. Yeah, mate, it's one of those things. You've got to be very selective, in my opinion, now with Perth and kind of how far it's gone as well. There's some areas that I believe still have a lot of growth left in the tank, and there's others that have had a heap. And they'll still probably have a little bit, but like how much is left in the tank, income to house price ratio, working that out as well, being very careful on that front. So we're very selective now with where we kind of still buy in there.
Okay.
But if you look at the last 12 months, there's a good split in there. And then a nice split over in Queensland as well.
Okay. Yeah. still a lot happening in Queensland and Western Australia. But
Yeah, mate.
Good. So you're going to continue to grow, or you're just going to go, that'll do?
The portfolio?
Yeah.
Yeah, because there's stuff that comes through that no one else can buy.
Yeah.
And if everything stacks and they make sense, like, what's the point of letting it go? If I can put whatever, if I can make the right numbers on a deal work, even whether it's from cash flow, whether it's from a growth and an equity perspective, if it's too hairy for a client but it still stacks for me, then I'll pull the trigger.
Are you keeping money in offset, so if anything comes in, you just buy it without worrying about debt? Is that what you do? Or I do a mix.
So I definitely get the pre-approved. And even if I do buy things like that, because I'll build things in cash, right? So that kind of continually grows and swells. And so if the right deals come through while I don't have pre-approvals, I might just buy something in cash. And the next time I go for a pre-approval, I'll just refinance that back out as well. So I do a lot of that too.
A lot of that. So you've got a good mortgage broker then, do you?
Yes.
Yeah.
Yes.
which and how do you hold all these properties in trusts and stuff?
Yeah. So I do a lot of structuring work.
How many different trusts do you have? Like,
what am I up to
got a
now?
few.
Yeah, I'm. If you include the SMSF, I'm at like 16 or 17 trust structures.
Oh, God.
Yeah, because you've got to have a mix. You don't want to have complete exposure, like 54 properties spread between, imagine 2 or 3 trusts. Like you've got 20 properties, plus the 54 doesn't include additional rentals. So realistically, there's probably 70 odd rentals there in that portfolio. That's a lot of exposure to put, say, 10 of those, maybe, which might equate to 15 rentals into one trust.
Yeah.
So I've got a way of breaking it up, but that's...
Yeah, that's
the secret sauce.
And it's School of Property, you find out where.
That's it.
But it becomes a full time. Like it's a lot of work, right? Like managing all those trusts, and I don't know. You probably got your own way. You probably name them certain things so you know what's what. And but if you're going to play the game, I think use the term. Investing in different states under different trust structures, you get different land tax rebates and all that sort of stuff, right? Like it's full on.
Probably the easiest way, without going too in depth in how I do run my own portfolio, is I do a lot of clustering. So if I believe strongly in an area, I have no issues buying half a dozen properties in that area in a year, or 10 in 2 years, sort of thing, in one area. If I believe strongly in it, that it's going to perform, and it's always paid off for me when I have, I'll do that, because then I'm dealing with one property manager who might manage 10 properties, 15 rentals in one area. They're going to look after you on that front. They're going to learn what to bring you, what not to bring you. And that's what I found has been a very, very key part of being able to continue to scale and not blow my head up with a lot of stuff going on as well, has been, having that cluster strategy.
Yeah. And clustering is good because only it gives you bandwidth, right?
Yeah.
It allows you to scale. Otherwise, it's just, to manage 13, 15 different property managers is a nightmare in itself because they change it by the day. So who actually manages your portfolio? Do you actually have someone that now manages it?
Oh, in terms of
administratively sort of.
I do these days, So pretty much just my EA that I have in Australian Property Scout, she just pretty much handles all the sort of stuff that kind of comes in and out. Yeah. And she'll just bring it to me once a week. Here's a little thing of these are the things you need action. But every week it might be like 4 or 5 things, releases or moving space out, little repair here or there. We do it in 10 minutes once a week.
Okay, and your accountant must know what they're doing then.
Yes. Yeah, of course.
How do you find getting finance? Is it because you've got a clustered siloed? Like when you go for a new loan, they don't ask for 54 different mortgage documents or, every single one of those trusts would need to be done and financials done all they do. Like that's hard work.
Yeah. I'll leave that one for School of Property.
Okay. All right,
when it comes to financing and structuring and like scaling a portfolio significantly, there's very key steps and very key process you have to go through to really be able to build this thing properly.
Yeah.
And so man, that's
School of Property. But my recommendation would be if you want to actually build a big portfolio like that, you need to be organised. Like if you're disorganised and you don't like administration and paperwork, good luck.
Yeah, it's not going to happen.
Good luck.
But you need to be able to outsource. You need a team, to build to that sort of size. Like I'm only as good as the team I got around me, the property managers, even like the EA managing all the component that she does. If she was no good at it, it would still be a headache for me.
Yeah.
But she's extremely good at it, very organised, keeps it all together. But we're talking about a 70 plus rental portfolio. But then even, the accounting side of things, the brokering side of things, all these different things as you're kind of building it. If you've got an average team, you're only going to get average results. But if you've got like a top tier team, you're going to get top tier results and build to, not everyone wants to build a 54 property
be careful
portfolio.
What you wish for, right?
Yeah. But even getting to, it might be even getting to 10. You can't get to 10 with an average team. You still need to have a great team. 10, 20, you need a really, really solid team.
Yeah, and again, no doubt it's all in the school of property, right?
It is.
All right, but I want to sort of get into some pillars of stuff just before we close out. But give me one place you're investing right now. Now, you're talking about exiting. Where are you exiting?
Where am I exiting?
Where have you just exited it?
Like stopped buying or started selling?
Stop buying. Somewhere where you're buying a lot, where you're not buying anymore.
Oh.
Because you're probably buying in and around it.
Yeah, there's been shifts in the last little bit. So like in the last 3 to 6 months. So
okay,
a few markets that kind of had their peak. They kind of peaked out at the back end of COVID. They came off. They had a dip. They went very lackluster, and then some opportunities started opening up. Markets started changing a little bit, so we've kind of re-entered to an extent at good money. So, sorry, mate.
You're gonna have to call these guys up, get all the source, or go to the Fast 50 report. How many places are in the Fast 50 report that you're probably buying? Probably a few.
I haven't opened it yet, so I'm not sure. Yeah, I think I saw it hit the inbox.
Maybe you can report back on that.
Right,
but
I'll let you know.
Anyway, but let's some easy stuff for people to build their portfolio growth around.
Yes.
Welcome back, Phil Tarrant, chatting with Sam Gordon from Australian Property Scout.com.au.
There you go.
What it is?
Yeah, it is.
Australian Property Scout.
Actually, yeah, that was good.
You do more than just scouting. It's one bit though. Did you struggle with the name? Like, finding it is just a bit of it. Like, we're just chatting about our
business names are so hard
to do it properly.
Yeah,
it's a lot more than just finding.
100%. Yeah. Like in terms of you mean in terms of actually finding the deals and stuff?
No. About calling it Scout is just one. It's good enough. I like Scout.
Thanks, mate.
It's cool. The portfolio. So talk about your portfolio.
Yeah,
you got some pillars around it, and I actually have some notes here, which is surprise, doesn't happen very often. Which no doubt you've used these pillars to grow your portfolio. I'm going to say the pillar, there's 10 of them, and you're going to tell me what it means.
Yeah, 100%.
So pillar one, get educated. We sort of touched on that beforehand.
Yeah, I think but even just to dive a bit deeper on this, because you kind of asked me like, how would you kind of tell the story around this thing as well? And I think it really comes down to like all these pillars as we go through them. I think they kind of, each one sort of feeds into the next. But getting educated is probably the key thing, because one of the biggest mistakes we see people make is they won't get educated, and Jim from the pub or Uncle Bob from the barbecue on the weekend or whatever says, oh, mate, this is the best place to invest in. It's your own backyard, and it's done 120% growth in the last 5 years, and the market's shot. But you listen to Uncle Bob because he's got 2 investment properties, and you go buy in the same spot. And what we see so many people is that they make that mistake. They don't get themselves educated, and they just go pull the trigger without doing a bit of research. When they go buy a property, then they're like, oh, I don't mind this thing. It's property, it's bricks. I own this house. And then they'll start doing research then, and then they come into a lot of they realize potentially the mistake they've made around that. So I think like getting educated, it will allow you to realize what is possible, what you should or could be aiming for, and then start getting educated around that, going to the next level.
Yeah, it gives you perspective, getting educated, and helps shape how you're going to go about doing it, which is pillar 2, creating a strategy, right? With education, you can then start thinking about what you're going to do with it.
Definitely. I think strategy is like, again, these 2 points have to come before pulling the trigger, because the strategy really comes down to what do you need next in the portfolio? That's what we always work out when we sit down with our clients, and we're like, okay, well, what are you moving towards? Like, what are the goals? What do you need in the portfolio to hit those goals? What are the deals you need next, or the deal that you need next is going to keep moving you forward? And that always changes for everyone. But I think like creating a strategy is really, really important, because people can underestimate or massively overestimate where they actually want to go. But when you kind of figure out what's that goal that you want to achieve, and then you create the strategy how to hit it, it makes everything a lot more refined, clear. You know what I mean? Like they know what they're chasing, and they can create like a proper game plan around it to then execute on the correct deal.
So this is like a bit of a cheat sheet for investing in property. Pillar 3, taking action, pulling the trigger on the right property. So that's the right location, the right price.
Yeah.
Where a lot of people get it wrong.
Yeah.
Wrong location, pay too much.
Same as Uncle Bob, at the weekend barbecue. You can't just be taking the advice from those sorts of guys. You got to, but getting educated and then creating the strategy around it, you'll figure out what you need in the portfolio. And through that piece of getting educated, whether you get educated and you try and do it yourself, or you engage a professional to get out there and try and give yourself the biggest and best advantage possible to select the right location, because the right location will do 80 to 90% of the heavy lifting. You buy at the right price, it's going to obviously it's going to help you, it's going to give you that chunk and help you get towards the next deal. And obviously give you the biggest and best return on your money. But if you buy at a discount in the wrong location, whoop-de-doo, you're stuck, right? But if you buy at a really good price and in the right location, mate, that's what will really set the portfolio up. And it doesn't matter whether it's your first deal or moving forward. They're super, super key points. You can't just keep buying in the same area, especially if it goes through significant growth. You got to move on, continually assess, and learn new markets.
And it's the layering of the success that you're talking about. It's the correct location at the right price at the right time, and just keep repeat.
Yep.
But you need to probably tap into pillar 4 here, which is recycling equity and maximising lending or strategic lending.
Yeah.
Right? That's when you're in accumulation phase.
Yeah.
That's what it's all about. It's a game of finance.
100%. Recycling equity is probably like your biggest cheat code for building a substantial portfolio, especially when you're young, especially when it's early. It's funny, like when I bought my first one, and I knew I had equity in there because I did a little cosmetic reno, and I was up about 50, 60 grand after about 6 months. And I remember, and I was because I was probably reading an article by you or something, and or someone in your bloody magazine, and I knew kind of how it worked. I learned how it worked, but then I called the bank and I was just kind of like chatting to them about it. I think I'd bought it through ANZ or something. It was One Direct. Remember One Direct back in the day? Subsidiary ANZ. Yeah. And I was chatting with them, and I'm like, oh, so you just give me the money, yeah? And they're like, what do you mean? And I'm like, well, I've got equity. Don't you just give it to me? That's my deposit. And they go, yeah, but you got to get a loan. I'm like, why do I need a loan? Like, it's there. Just give me
my money.
It just didn't work until I actually did it. And then when I pulled it out and that deposit, the next deposit hit my bank account, light bulb moment. Like I never really realized it before how it can work. And this is where, like, it's funny. People ask me all the time, do you still get a buzz out of this thing? Like, doesn't it get a bit monotonous or a bit boring? I had a client the other day that bought a property late last year, paid $390, just had it valued at $500. It was actually like, we bought it like 4 months. I think it was 4 months ago he bought it. And he texted me, and the dude's just like, mate, this is like, you told me this was like, we were going to get the result. I never told him 4 months, but he's got this, and he's like, mate, I'm getting the equity out. I'm getting a new pre-approval. And
but he's probably sitting
there
going, I've done nothing and I've just earned more money than my annual salary.
Yeah, he makes like 80 grand a year. Dude's like 24. Yeah. He's just made that. And it rings in my mind because it was on the weekend that he sent it to me. And I think like understanding the power of that and utilizing it and then building it in that way.
And it's a light bulb moment for a lot of people where they go, well, what do you mean recycling equity? All it is that you buy a place, it goes up in value, you refinance it, you take the money, you refinance it back up to 80%, whatever the difference is between the valuation and what the debt is.
Yeah.
You can use that as another deposit.
Yeah, essentially cash it out. You pay the loan on, it's another loan on top, but that equity will then go into an offset or a redraw or bank account, whatever. Use as deposit for the next one.
And sort of pillar 5, managing cash flows. Doing cash flow deals when you do it inside of your portfolio. But this is it. So you got to be able to hold your portfolio so you can get the capital growth.
This is the key thing. This is where a lot of people, they'll just go, oh, well, bread and butters, they're amazing. Yeah, I just made that example. I just made 110. I'll just go to another 2 of them, or I'll go buy one and then go straight into the other one, sort of thing. And like cap themselves with lending, especially if they're on a bit of a lower income. And while it's great, and yes, they'll still get a great result, a lot of the time it's not in line with their goals to then stop at 2 or 3 or potentially 4 properties. So they need to manage the cash flows and understand it. And not only from like the deals that they're putting in, but even in the sense of if you're leveraging this portfolio up and you're pulling out equity and you keep building it, you're also keeping the debt level very high in your portfolio. So you've got to really manage that and make sure you can afford it and look at the portfolios and overall how much surplus income do you have that can take care of this, service this extra debt while we're going through this period, especially on higher interest rates. So that you can manage it and actually keep accumulating. But then that's where a lot of time where the cash flow deals will come in. You execute a good solid cash flow deal, great yield, that is going to help hold it. It will have more positive cash flow coming in that'll take care of the other debts and it'll keep that serviceability strong so you can keep moving forward.
And again, it's not only cash flow, it's this pillar 6 is building a strong team and looking after them.
Yeah.
Got to do it.
Yeah. It's the most important thing. I look at where I got stuck after, I think it was 6 or 7 years. It was about 25, 26. And you probably remember the story. I burnt by a buyer's agent back in the day. And right. I looked around for a year and I was disheartened and I was just in a very bad spot there for like that year after I got burnt by the BA. And then I came across, I was banging. Then I was like, nah, you know what I'm going to do is I'm going to have a crack. And I was going around to all the lenders and all the brokers and everything. And everyone was like, mate, you're stuck anyway. You can't do anything, blah, blah, blah. And then I met this one broker that pretty much opened the door for me and goes, this is what you need to do if you want to keep moving forward. And then she put me in touch with a gun bloody accountant. And then it was game on. Then
so it's still your broker today and accountant today?
Yeah.
Same people?
Same people. And that's why, like, it took me a while to find that team. But then when you find that team, it's so, so important. And probably the reason I put down there is looking after them as well is, like, what you got to remember is, and this kind of comes back to everyone. If anyone's good at what they do, they're busy, and you can't get pissed off at them because they're busy. If they're still looking after you, still doing a great job for you, it's part of the process of someone being really good. They're going to be in demand. So I get a lot of people like, oh, the broker didn't come back to me. It's been 2 days. And I was like, bro, you emailed them on the Friday. It's Sunday or Monday. Like, give them a follow-up.
Relax.
Like, either give them a little follow-up or like, you just got to understand these things take time. And if you want to work with the best, they're going to take a little bit to assess your situation and get everything through as well. You're not working with, Fred down on the corner that's got no clients.
Yeah, you can't ride people because they're just going to get pissed off and go, I don't need your business.
Yeah,
mate.
exactly.
So, a little bit of patience.
Yeah. So I think that's a super, super important point. And you're probably right, man. The patience on the back end of that is massive.
Yeah, because good people will sort it out. And again, it's also another capability. This is pillar 7, mental endurance. So having a really good, strong investor mindset on the basis that, said it's simple, but it's not easy. Property investment, like the basics to create wealth: buy good property, hold on for a long time, and you'll create equity.
Yeah.
Mate, not as easy as you think.
This is one of those things where most people are pretty realistic when they first start and everything, but like a lot of the time you'll get something and people, they'll whinge at deal 1 and they'll whinge at deal 2, and you're like, let's say you made 25, 30 grand on the way in or something, right? And then the property in 6 months has gone up another 60 grand. And they're whinging because a tile's broken on their roof 6 months later and it's a $500 fix. Like, oh, but this wasn't picked up in the building and pests. Tile's broken on the roof.
People say that?
Mate, I've had it.
Yeah,
and
you just go, oh, come on.
You can't believe it, man. Yeah. And then they're getting in their own way, and then like a tenant will default on a thing because you put your rent up because the interest rates went up and the rental increases went up, so you put your rent up, and then maybe they weren't able to repay and it defaulted, and you got to move them out and put someone else in, and they're like it's the worst thing in the world. And when I first started, it probably would have stressed me out as well, and I understand it. But it's almost like that armor, right? Or that David Goggins, right, talks about like callousing the mind, and you got to constantly be building the calluses, and you got to look at these things. It's just continually callousing, like hardening you up. That mental endurance is getting stronger and stronger the more you do it. Because the more you do it, the more shit's popping up. Remember what I said before? I would get 5 to 6 to maybe 10 things a week that I have to handle on a portfolio my size. Yeah. Like it's one of these things you if you want to get in the game of property investing, you're dealing with bricks and mortar and people. Things that always over time will have an issue. So you just got to be realistic about these things. And this is why that level of deal that I'll go and execute, maybe 1 a month sort of thing, over the last, however many years, they're the sort of things that I buy. So few people are at the mental, probably strength capacity to take that stuff on and it not implode them. You can level them up with things in the middle, but that really crazy stuff at the top end, it's like, I know I can make it work. It might blow out. It might come in under. But there's so many moving parts to this thing that most people's minds will just blow trying to comprehend it. So,
and this comes down to compartmentalization is a really good tactic. Like working out what I really got to worry about and what I don't really need to worry about. Like I spend my life just going, I don't need to worry about any of that. Yeah. Look, I know it's there. It'll be a problem at some point, but I'll worry about it later.
Yeah. Yeah, there's strategies around like how to manage, especially like holding properties as well, and being really kind of cutthroat with that from a strategic investor perspective. So you're still doing the right things, but you're not allowing yourself to cook your mind over it.
That's pillar 8, right? Reassessing the portfolio, right? Like assessing. Yeah. Is it right? What do I got to do? What's next? Is it all right? Can I leave that? What do I really need to take charge of? Take action, execute.
Yeah, 100%. And I think like it's also things change in life. So you might get 2-3 years into your portfolio, and you might have been on a really low income, and all of a sudden something's mad's happened, and you're making significant money. Or you might have been on significant money, and now that job's been made redundant, and now you're back on half that or something. Yeah. So things always change, and I think like we always re-strategize after every 1 to 2 deals, depending on how many they're buying at a time. A client will always re-strategize their portfolio every time they've done a deal or two, just to make sure they're on the same path, same trajectory, nothing's changed or anything we need to implement or take out or whatever, to be able to keep them building towards their goals. And so I think it's really, really important sort of thing to keep reassessing and keep re-strategizing the portfolio.
So pillar 9, and sort of, I guess your testament to this, consistent accumulation.
Yes.
So always buy more. There's got to be a point where you stop, right?
There is, but like while you're working towards your goals, consistent accumulation is key. The last 2 here, in my opinion, are the keys in actually achieving your goals. So a lot of people with consistent accumulation, they might buy one and sit on the sidelines. I'm just gonna see how it goes for a year or two, and like that's fine, right? But if you've got big goals and you want to achieve 200 grand net passive in the next 7 to 10 years or something like that, you can't sit on the sidelines. You got to roll the dice. You got to have a crack at this thing.
Got to get involved.
Yeah, and what I've always found is like that consistent accumulation, the people being willing to go out there and buy a property every 6 months, right? And refinancing that equity, buy the next one, and then 6 months later they're going through the same process. They're refinancing, they're pulling equity, they're buying again, and then when they get to the point that they can do doubles, they're doing doubles, you know, and they're building it in that phase, in that scale. And when you front load the portfolio as well, you're giving yourself as much time as possible for the growth to come through and properly enhance your portfolio.
Yeah.
If you sit on the sidelines for a year or two, you're going to miss opportunities. So I love consistent accumulation. I bang on about it all the time. I absolutely love the idea and the methodology around that.
Yeah, and you've got to be active on that basis. And you know, I speak to hundreds, if not thousands, of property investors, and I put myself in the same bucket. You ask anyone, what would you do again differently? You go, I wish I started earlier, and I wish I did more. and even now, I sit there now, I just think about my portfolio. I could be buying a lot more property right now than what I am. But I just go like, something else comes up, right? You know,
but in 5-10 years, you might look back and go, "Shit, I wish I
will do."
Yeah, I wish I loaded up.
I wish I bought heaps last year. Wish I bought heaps the year before. You know, but I just haven't got around to it. But look, it's not that I'm not doing stuff, but and it gets to a point in your portfolio, pillar 10, consolidation. So it's a period where you just go, and you might consolidate a couple of times.
Yeah,
you know, multiple times through your portfolio journey.
Yeah,
you don't consolidate. That's it. You might consolidate, wait, go,
yeah,
different, and that's where you can sort of tweak the strategy sometimes. You know, I've sort of gone through that recently where I've sold off a whole bunch of stuff.
Yeah, I remember hearing,
and consolidated, buying again, but very different sort of stuff, right? You know, buying stuff now in the millions rather than 300,000, right? You know, but I was once upon a time buying those properties.
Yeah, 100%. And that laid the foundations to now move into the style of asset you're buying now as well. You know, you've just gone to a different, again, it's like a strategy piece that you went through that now you're taking your portfolio to a different part.
You don't buy as many.
No.
But the numbers are much bigger. Yeah. You know, and that's okay.
Yeah, no, I'm with you, mate. Yeah, for me, consolidation's a huge piece of the strategy, and it's just like it's something that everyone has to build into the portfolio. The old adage of buy, and never sell. I hate that. It's literally, if there's one term in the whole property industry that I hate, is when people say that, because it's just absolute lunacy. People who say that, go out on a limb here, they've never done anything significant in property themselves. Ooh. Because you cannot buy and never sell and keep building a portfolio. You can't do it. You reach debt ceilings. It's unavoidable at some point. You want to build something significant, you have to sell at some point to get the debt back and keep going. Trade
a bit. Now, what's happening on the 13th of April?
Oh yeah, we've wrapped the 10 pillars. We're on to the 13th of April.
We're going.
Mate, sorry.
Been for an hour.
Bit over time. Yeah. Mate, the 13th of April, we've got the Australian Property Scout Summit. So never done it before. Just made a decision the other day. I'm going to run this thing, and we're pretty much, mate, we're going to record a couple of podcasts live in front of the audience. We find the Scouting Australia podcast audience, mate, they love the banter. We rip each other, we tear each other apart, and it's good fun. We've got a couple of round table sessions there with the team as well. I was going to do a round table with the APS team, Q&A live with the audience. Okay. There's just heaps of like investing stuff we're going to run through from the day as well.
Where's it at?
It's in the Goldie.
Okay.
You have to fly out for that one, mate.
Oh, man. Well, am I invited?
You're invited, mate, of course.
Oh, God. On the 13th of April.
Yeah. So it should be good, mate. I'm looking forward to it. It's something I've had in the back of my mind for ages. I used to do a lot of those property seminars back in the day, but they were all like trying to sell you into like a 40 grand program or something crazy. And mate, this thing, it's not, mate, I'm not literally what I'm selling the tickets for. We actually worked out this morning. It's actually costing a little bit more per ticket than what we're selling them for, but I don't care. I just kind of want to, I want to do this.
Where in
the
Gold is it?
Location to be confirmed. Okay. We're just wrapping up with that at the moment.
There you go. Okay. But 13th of April. Is that a Saturday? Is it?
It's a Saturday. Yeah.
Saturday.
Yeah.
And you're going to just do some function afterwards, sort of cocktails on the beach or anything like that?
I don't know, mate. We'll probably do something. Maybe. We'll do something.
Okay.
But it's a cool thing as well because man, what we're doing is if this is a success, I'm hoping it's a success. If it is, we're going to run these once a quarter. And what I'm pretty much going to do is I pick 5 people. It doesn't cost anything. I pick 5 people out of the kind of the last cohort that came in the last quarter of School of Property students. And I pick 5 of them. And on the day, I'm going to be releasing those 5 for mentoring students that I'll mentor for a 12-month window in their own portfolios. I'm not charging for it. I just want to I literally want to scale some people's portfolios properly. So
there you go.
Yeah, man. So it should be good. Looking forward to it.
Cool. 13th of April. Go and check out AustralianPropertyScout.com if people want to register, I imagine.
Thanks, man. Yeah.
Look at that. Look, I'm plugging you
mate,
all over.
Mate, you're doing really well. You're doing more than me today.
Well, I've got some notes. Look, I've got 1 page here. I never get it.
1 pager.
But half of that there is pillars. So,
yes.
Good. All right. Thanks for coming down, mate.
No worries, mate. It's a pleasure. Thanks for having me on.
Yeah, it's good.
It's a good session. I enjoyed it.
I will be up at the Gold Coast at some point, whether it's on the 13th or not. I know I'll be up there for the big real estate conference in May.
Yeah, right.
It is, which is cool. But that's Sam Gordon, AustralianPropertyScout.com.au. Go and find him there. You're all over the Instagram, or you do all that stuff, or it's just best to go to your website?
Yeah, we're on the, if you go to at Australian Property Scout or at Sam Gordon Property, we'll do a fair bit on, at Sam Gordon Property is probably a little bit more on the Ferrari side, and at Australian Property Scout is a little bit more on the property side. But there's a bit of mix, mate, there's a bit of crossover.
Got to mix it up.
That's it.
Go and check it out. Sam Gordon, he's Director at Australian Property Scout, back on the podcast. An hour and 10 minutes. Maybe this will be one of the top-ranked shows of 2024. Who knows? Stranger things happen. Remember, check out smartpropertyinvestment.com.au. Go and check out the Fast 50 report as well, which is out. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.